Did you know that dividend stocks can give you a regular income without you having to do much? They also help protect your money when prices go up, and they act like a cushion when the stock market gets shaky. These stocks pay you money just for owning them. But not every dividend stock is the same. Some are better than others in terms of reliability, profit, and staying power. How do you figure out which dividend stocks are the best for the long haul? Don't miss this video to discover 9 dividend stocks that Charlie Munger would be interested in. We've divided them into 2 videos, featuring 5 stocks in each. Make sure to stay with us till the end to find potential investment opportunities. Before we begin, show your support by liking, commenting, sharing, and subscribing to our channel for more useful financial tips. Don't miss out! Before you dive into investing in dividend stocks, let's understand 2 key terms. Term 1. Dividend yield. The dividend yield is a ratio that tells you how much money you make each year for each share you own, given as dividend payments. When investors pick stocks or funds that pay dividends, they often look at the dividend yield. Now let's explore the second term, payout ratio. The payout ratio is a gauge of how much of a company's earnings are distributed as dividends to its shareholders. It's a crucial metric that provides insights into the sustainability and potential for growth of a company's dividends. For instance, if a company has a payout ratio of 60%, it signifies that 60% of its earnings are given out as dividends to shareholders. This ratio is a key indicator for investors assessing the health and outlook of a company's dividend payments. Let's talk about the first stock on Munger's list. 1. Coca-Cola, KO. Coca-Cola is a super famous brand known all around the world, found in more than 200 countries. They've been paying dividends, basically sharing profits with shareholders, since way back in 1893. What's really impressive is that they've increased the amount they pay to shareholders for 59 years straight. As of November 2nd, 2023, if you had 1 share of Coca-Cola, it would cost you $54.66. And guess what? They pay you back a little, about 2.9%, which is like $1.68 per share in 2023. Coca-Cola is generous with dividends, doing it 4 times a year. Now there's something to know. Coca-Cola has a payout ratio of 87.05%. This is like saying they give away 87.05% of their earnings as dividends. It's a lot. While this high ratio shows that Coca-Cola is a solid and established business, it also means they might have less money to invest in new things or grow in different ways. 2. Costco. Now let's take a closer look at the next pick on Munger's list. Costco, Cost. Costco stands as the biggest warehouse club retailer in the US, boasting over 800 stores across the globe. It's recognized for its affordable prices, top-notch products, and a customer base that sticks around. Costco has been sharing its profits with shareholders since 2004, and they've consistently upped the amount for 17 years in a row. As of November 2nd, 2023, if you were thinking of owning a piece of Costco by grabbing 1 share, it would set you back $462.29. Now the dividend yield, which is like the interest they pay you for having a share, is 0.8%. While this might not be a super high percentage, it's still something extra. Just to give you an idea, for every share you own, you'd receive a small portion of money as a dividend. In 2023, if you owned a share of Costco, they would have paid you $3.60 as dividends for that share. Costco is generous with dividends, and they do this 4 times a year. 3. Johnson & Johnson. Johnson & Johnson is market leader in healthcare. They make medicines, medical tools, and things you can buy. The company has been giving money back to its investors since 1944, and they've increased the amount for 59 years in a row. On November 2nd, 2023, 1 share of their stock cost $150.24, and they paid a 2.5% reward to investors. This means, for every share they gave $4.76 as a reward in 2023. Costco also gives money to its investors 4 times a year. The payout ratio for Johnson & Johnson is 91.6%, which means that the company pays out 91.6% of its earnings as dividends to shareholders. This is a very high payout ratio, which implies that the company has a stable and resilient business, but also constrains its ability to invest in research or development. 4. Procter & Gamble. Procter & Gamble is a giant that makes everyday products like Tide, Gillette, Crest, and Pampers. They've been giving money back to their investors since way back in 1890, and they've increased that amount for 65 years in a row. On November 2, 2023, one share of their stock cost $149.80, and they paid a 2.4% reward to investors. So for every share, they gave $3 as a reward in 2023. Procter & Gamble gives money to its investors 4 times a year. They use a payout ratio of 65.20%, which means they share 65.20% of the money they make as dividends with their shareholders. This ratio is considered moderate, suggesting that the company has a good and balanced business. It also means they have some money left to invest in new ideas or buy other companies. 5. Starbucks. Starbucks is the biggest coffee shop in the world with more than 30,000 stores in 80 countries. Since 2010, Starbucks has been sharing profits with its investors, and they've increased the amount they share for 11 years in a row. As of November 2, 2023, one share of Starbucks stock cost $118.30, and the percentage of the investment that gets paid back as dividends is 1.6%. In 2023, for each share you own, you'd get $1.92 in dividends. Procter & Gamble, another company, gives money to its investors every 3 months. Starbucks shares about 35.36% of its earnings with shareholders as dividends. This percentage is considered low, indicating that Starbucks has a strong and growing business. The company also has enough cash to invest in expanding or enhancing its operations. 6. POSCO. Next is POSCO Holdings, a company that Charlie Munger confidently invests in. POSCO specializes in producing steel products through various segments of its business, including steel engineering, construction, and trading. Up until September 2023, they have distributed dividends amounting to $6.79 per share over the last year. Considering the current stock price at $447.12, the dividend yield stands at 1.52%. Considering investing in POSCO has its merits. The company holds a dominant position, controlling around 40% of the local market share in South Korea. Additionally, they engage in substantial steel exports to other Asian countries, suggesting a steady income source over the long term. This stability is appealing for investors seeking prolonged returns on their investments. Moving on to the next pick on our list, we have Jeff's Financial Group Incorporated, a versatile company deeply involved in various financial activities. Their services encompass a wide range of financial transactions, including facilitating the buying and selling of companies, providing loans to businesses, trading stocks and bonds, and overseeing wealth management for individuals. In the fiscal year 2021, Jeff's Financial Group demonstrated robust financial performance, earning nearly $1.7 billion in profits on a substantial net revenue of almost $8.2 billion. 8. Viatris. Our next forever buy and hold option is Viatris, a pharmaceutical company that you need to keep your eyes on. Viatris has a solid source of revenue through its pharmaceuticals, which have the potential to generate substantial income over an extended period. Viatris enjoys a certain level of resilience in its business, as people typically cannot forego their medication even in challenging economic periods. This characteristic provides a level of stability for the company, making it less susceptible to downturns in the economy. Additionally, Viatris offers investors an appealing feature, a dividend that might seem almost too good to believe. The company's dividend yield stands at 4.5%, surpassing the average seen in the broader market. 9. Ares Capital. Last but not the least is Ares Capital, which is a finance company specializing in providing loans to middle-market businesses. These businesses typically generate profits ranging from $1 to $250 million before accounting for certain expenses like taxes. Ares Capital has a noteworthy track record since it started trading on the stock market 2 decades ago. Notably, they have consistently provided investors with higher income compared to average alternatives. This is mainly due to the substantial dividend they offer. currently standing at an impressive 9.8%. This high dividend yield makes Ares Capital an attractive choice for investors seeking substantial income from their investments. That is it for today. We will see you in the next video.